Tienes fan club, eh?
El fan club in Miami.
Yeah. They all flew here for you. So, thanks everyone for being here. This is a great set of panelists. Likely, I know most of you guys, so it's an honor for being here. So I think this is one of the last conversations that is going to be happening before the startup competition and the finalists showing the great things that they are doing, and then we'll have a South Summit winner. Before we start, I'm happy. This reminds me of very good memories, as in 2016 with Spodahome we won the competition. So I guess that's why. Thanks, Ren. It's been a while. I feel like an old man now. So guys, what if you guys give each one a 1-minute introduction? They are all incredible investors worldwide, so I'm looking forward to the conversation. So if you want to start, Miguel?
Yeah, I can start for sure. Thanks for having us. Thanks for coming, everyone. I'm Miguel Nigorra, head of Europe and partner at Fifthwall, based out of London, from Madrid originally. Fifthwall, the way to think about us is we are the largest venture capital fund in the world dedicated to a very specific vertical, which is real estate technology and innovation. We started in 2016 in the US. We have about $5 billion under management right now. And over the years, we've backed and taken public over 15 companies, 7 of them last year. And I take care of all investment activities for the fund in Europe. We have 2 main strategies. The first one is real estate technology innovation. The second one is climate tech. Everyone is talking about climate tech, so also happy to share more about that in a minute.
Hi, everyone. I'm Francesca Casella-Covi. I am the head of early stage investments for the Venture City. I joined the Venture City a year ago. Previous to the Venture City, I was at Meta, Facebook, for 8 years, where I led new product teams on the business development side. So I grew and scaled products facing high regulatory risk, because my background before that is in finance and in US government. I also serve as the advisor for Mayor Levine Cava, who's the mayor of Miami-Dade County. And so I'm really excited to be here representing Miami. For those of you that don't know the Venture City, we are an early stage investment firm. We invest in the US, in Spain, and in Latin America. And our deal size tends to be pre-seed and seed. And then we have 2 VC funds that do later stage deal, of which Spodahome is an amazing portfolio company. So we're really excited to be here on this panel.
Very good. So my name is Javier Villamizar. I'm an operating partner at the Southbank Vision Fund. For all of you that probably haven't heard the name before, we are one of the largest technology funds in the world. We have been deploying around $150 billion of capital in technology companies. Kind of the investment thesis behind these companies is the use of advanced technologies like artificial intelligence, machine learning, data science, blockchain, in order to disrupt traditional industries. So we have a very broad mandate. We invest in prop tech, in ed tech, in health tech. My job is twofold. One, I support my investment team partners, helping on operational due diligence, kind of looking under the hood of companies before we invest. And after we invest, I do a lot of value creation for the portfolio, so help them with geographic expansion, with portfolio synergies, M&A, structured finance. I'm an engineer, Colombian. Have been here at South Summit for a few years. Big fan of the platform and super happy to be here.
Woo. Hi, everyone. My name is Pep Eng. I'm an entrepreneur converted into a VC. I'm probably the one with least experience here on this side of the table. But I was one of the founders of a company called Chartboost in the ad tech space in the Bay Area, and recently moved back to Barcelona, where I'm from. And I'm one of the partners of Pear VC. For those who don't know Pear VC, we're an early stage fund. We've been around for 8-9 years, and we just want to be helpful. My partners and like myself are former founders, very passionate to help founders that have big dreams and want to build category-defining companies. We've been honored to partner with many great founders. Some of them we share with Southbank. We should be doing more because DoorDash and Garden Health, which are 2 of our IPOs, are shared. And recently moved to Barcelona to open Pair Europe. So very excited to be here. Traditionally, Pair has invested mostly in the US, a little bit in LATAM, and now I'm Pair Europe. So excited to meet more founders in the region.
Nice. Excellent. Well, you keep being an entrepreneur. Yes. Different way. All right. So let's start with kind of the hottest topic. So everyone is talking about how the financial markets are shifting, and then so as I think in the audience we have both early stage founders, but also later stage founders. So I think it's going to be helpful for them to see what is your view. If you are an early stage founder, how should you approach the business towards funding? In terms, and I'm meaning more like growth versus profitability. And telling from experience, we have been 8 years, so it's been like kind of hyper growth at all cost, no margins, then kind of margins and growth, and now we are seeing the shifting towards profit versus growth. So maybe you guys can give us insights, but differentiating please between early and growth stage, kind of later stage, if there is a difference. I think that may be helpful for our audience. I don't know if we start with early stage. I don't know who wanna jump in. And
I can start. I mean, in most cases, we're one of the first checks. So all we have is great founders and hopefully great people, right? So we invest in pre-product, sometimes pre-revenue. So I don't have a lot to tell on that regard. But what we're looking at, we are looking at not unit economics, but a clear path towards a business model. We like seeing that from the very beginning. At the end of the day, for those who haven't been that exposed to the investment side, there's only two things that we have at the beginning: people and a market. So we want to understand these two, and then we do ask for a sense of a business model at Pair. That would be for pre-seed and sometimes at seed. For Series A, we do ask for unit economics. We spend a lot of time understanding the model, and it doesn't need to. We don't require profitabilities, especially at the kind of CM1 level, so margin at the top. But we do want to have a path. We want to understand at least the rationale on how are we going to get there,
even if it's pre-revenue.
No, I'm talking about Series A.
Okay. Yeah.
So at the Venture City, we focus on pre-seed and seed, so we want to be the first check, similar to what Pepe was saying. I mean, I think that you're investing in people first.
Yep.
The idea can change, but what we're doing is, who is the team? What is the problem? How do they want to solve it? And how are they uniquely positioned to solve it? You really need to have a clear understanding of what the problem is that you're trying to solve in order to solve it. And the problem, the solution may change, but you really, really need to be close to it. And I think one of the things that we're seeing is that people are going more and more, and investors are going more, and the question that they're asking is, what is this good for? It used to be that there was a lot of investment that was done sort of on vision, and a lot of investment that was done with these ideas of we're gonna be able to change something, but it wasn't as fundamentally rooted in, does this solve the issue that somebody has every day? And I would say that we're seeing more and more founders come in that really, really, truly understand that, and that are really focused on those dynamics. The other thing that I would say is that we just recently launched a document called Regression to the Mean, which is a crowdsourced document of advice for founders at all stages, so pre-seed all the way through exit, that gives really tactical advice on where they were in their business model. And our organization was started by somebody that lived through the first tech crisis now 20 years ago, and so we've brought those learnings in from the different moments in time. This is the third regression that we are seeing, and so there's lots of practical advice that can be applied in order to make sure that you navigate through it.
Mm-hmm. So we do Series A to C. So I would say, look, it's no surprise to everyone that it's a tough environment. But I want to build on what you both guys said, which is at the end of the day, maybe what venture capital lost a bit the perspective was on what the entire industry really means in the first place, right? Which is, you're betting on people, with a certain idea, and you're betting on a certain thesis, right? Obviously, if the thesis is incorrect, right, then or the team is not good enough, then the whole thing doesn't really work out. But going back to basics, look, there's going to be some difficulty across the world, by the way, not just venture capital, across any industry, with inflation at 9%, interest rate raising. That's not good for anyone. But having said that, if you think about it as an investor through the cycle, and at a Series A to C, you still have a long way to go on the life of your company, you shouldn't be that worried, right? And my advice is go back to basics. What are you trying to build? How are you going to fund it? What are the different stages that you're going to go through? And therefore, what is your plan A? What is your plan B? What is your plan C, right? Everything that we are saying about extend your run rate, focus on unit economics, try to get product market fit earlier, don't make certain decisions, expansion, don't make certain bets on investors if they're not the right fit, are things that basically we're talking about just having a plan A, right? Let's go with the plan A because who cares? There's going to be money out there. I'm going to partner with these guys. It's a bit like a relationship, right? I don't really like these founders or these VCs, but they're giving me money, so who cares? Let's see, well, when bad time comes, you need to rely on the other person. You need to rely on the relationship. You need to have trust on taking tough decisions together, right? So that's what I will recommend any of you launching a startup. If you're on a Series A to Series C, think about your business the same way you will in any market scenario. Think about your business through the cycle. Make some adjustments because you need to, but don't forget about what your North Star is and go back to basics, right? In terms of like, what is being an entrepreneur, what is having a plan A, a plan B, and plan C, right? And try to figure out, depending on where the market dynamics is, what's the best plan forward, right?
I'm a personal investor in seed companies, not through the fund, but in my experience, when you look at early stage companies, and probably this summarizes what Jesse said, I'm always looking for founder team problem fit, right? I'm trying to find that connection in between the talent in the team and the problem they are trying to solve. Obviously, the problem has to be real, but that connection is incredibly important. The other thing that for me is critical is that the founder, even though they have big aspirations and they want to conquer the world and they have these huge TAMs and SAMs and all that, they have to have a clear path on what is the deliverable in the next 3, 6, 9 months, right? It's not enough to have a great vision. You have to have some kind of a plan for the next 3 or 6 months, because that's how the money that you're gonna raise is gonna be used, right? If I'm gonna write a $50,000, $100,000, $300,000 check, right? You have to be very careful on how you spend that money and what you're gonna be able to deliver, so you can go to the next round and raise more money. So that's on the early stage. On the growth stage, we're in this new cycle of the industry where, you know, a few months ago, we were rewarding growth, right? Everything was about growth. Mm-hmm. Show me you're growing 200% every quarter and you deserve 80 times ARR valuation, right? That was kind of the formula. That has changed, and has changed because there is somebody out there that is called the public markets. And the public markets are very specific ways of measuring companies. And they not necessarily are giving that much weight to growth. They are looking for two things. One, some kind of profitability or a path to profitability. So that has to be relatively clear on the plan of a growth company. And two, they look for predictability. They look for a founding team, a CEO, a CFO that is able to, with certain level of confidence, predict how the business is going to behave in the next 3, 6, 9 months, right? You take away if COVID happens, or the war happens, or inflation, goes to the roof. But you have to have a management team that is able to understand the drivers of the business and predict how it will behave. And I think the third component that people reward today and is looking for is discipline. As a founder, as a CEO of a company in growth stage, you cannot lose that, right? Even though you're getting $100 million, $300 million checks, you have to be disciplined, right? Having too much money could be a problem. And people start doing crazy stuff, right? And they start investing in things that, oh, nice to have, or, oh, this is a great idea. We should be doing this and this and this. You don't want that today, right? You want to see management teams that are saying, this is my core business. This is a must-have. These are my priorities. Other stuff, all that's nice to have, I'm not going to do it. I'm going to cut it. I'm going to completely shut it down because I need to extend my runway. I need to preserve my cash. So you want that, clarity in the mind of the founder, that discipline to be evident when you are, discussing around. So the markets are not closed. It's just that those parameters have some way changed. And if you want to raise money today, you have to fit those new paradigms.
But then what would you say to many of the founders that today they are, reevaluating their plans, and maybe they are thinking, okay, should we have like a 3 years runway or 2 years runway, or maybe we are like few months away from break even, let's make the company profitable, lower growth, but it's profitable, no need of cash, and then we'll see what happens whenever there is more clarity in the markets, valuations are kind of more on a target from a founder's perspective, because I'm seeing that with other founders that we are having debates, and many are saying like, look, I'm thinking of just making the company profitable and not needing more capital as the market are. So I don't know your thoughts on that, but.
Can I take a step back on that question, and I will let the rest answer is, very rarely we see an entrepreneur that delivers on their own business plan. Very rarely. So the minute you see an entrepreneur that said that was going to get to 100 at a time, and they deliver on that, you say, well, I don't believe this. I'll double down on this guy, right? We are investors in one company where we've done it in 9 months, right, Javier and I. So that's the number one thing is people need to believe on your business plan, but you need to believe on your business plan, and you're going to need to achieve what you said, right? So the worst mistake is the fact that you are having to extend runway. Look, if it was because you were caught at a certain stage, it doesn't matter. But if it is because you have a plan, and if you don't like this one, I can change to have another one, right? Those are my principles. If you don't like them, I have other. That is a big problem in itself, right? Which is entrepreneurs need to try to make sure that on whatever business plan they set up for themselves and for their companies to deliver on it, right? And that's the number one thing, at least we're looking for right now. Mm-hmm. It's a bit less on how many run rate do you have? Because if you need capital and you have a good idea, a good company, we will give it to you. We're doubling down on our portfolio companies that are doing well. But doing well means not being the best, being the fastest, being the smarter. It means delivering your business plan quarter by quarter. And if something happens, explain why the hypotheses you had are not real for whatever reason, right? But it's not about throwing numbers out there and then hoping that they stick, right?
Yeah. One thing that I would add, though, I think your perspective is very much the multi-stage. For the super early, it's a little bit more delicate.
It is.
Because we are always thinking about the next stage, and we cannot help out beyond that stage, right? So we need to get that company ready so that someone like you guys can pick them up and help them beyond, right? Help them further. So for us, we are a little bit more cautious. I do need to give a very strong heads up to my companies to, if there is a path towards profitability or building stronger unit economics, just take it. Obviously, it's a delicate balance, right? It cannot go completely against your growth, but if there is a path towards showing signs of EBITDA, take it. Because I know that we don't want to be in a position where the company runs out of money and no one picks them up, right? And I think we're just at a different stage, right? Our job is to handhold them a little bit on Preseed Seed, and then someone at Series A will pick up the baton.
I think sorry.
No, go.
I think the answer is not really completely clear cut, right? We talk about picking your investors at the early stage or at the growth stage, right? If you have done a good job at picking your investors, the right ones, honestly, you have to just adjust your business, adjust your runway, adjust your cash burn, but if you have the right investors in your cap table and they believe in your business and you're delivering on a plan, then they should be there for you, right? So you should not be worried that, oh my God, I have to go and raise money in September and the market is dry, right? You would expect that people that have been with you in your last round, we're talking about growth, right? Not in your example, they will be there. So it is important. The other thing that I think you have to think about and differs from one sector to the other and one business model to the other is, what happens with my business if I completely turn off growth, right? If I go into what I call zombie mode, right? Is this a business that in 6 months or 9 months or a year, I can restart? Or how much is gonna cost me to restart? How much I'm gonna give up to competition, to incumbents, right? That's a trade-off that you have to think about. If you're not losing anything, if the window is big enough, then it's okay, optimize for extending your life. But if you're running against time, then going into that zombie mode is killing the company.
I mean, I think that what everyone is saying here is that fundamentals really do matter. And they matter at every stage of the business. And I think our job is to make sure that we instill a sense of product and data fundamentals so that later stage investors can pick up a company and say, now it's really time to put more fuel in the fire and make sure that we can really help you expand. But fundamentals matter. And I think that there was a misunderstanding that there is, a division. I love the way that you put it about the public markets. There is this belief that the public markets weren't going to look at fundamentals. And the public markets have been consistently looking at fundamentals forever. And now we're getting a realignment with the public market on fundamentals.
Yeah, I think this is super helpful for all the range of entrepreneurs from early to growth. So I'm not going to forget about other entrepreneurs because we only have 1 minute left. So I would like to ask each one of you, if you were about to set up your own company today, which sector would you go towards for the next 5 years?
Climate tech for me. There's 18 trillion that are going to be deployed in climate tech, especially for real estate or the built world, construction, all the boring industries that probably you don't like over the next 30 years. So that's a huge once-in-a-lifetime opportunity.
Nice.
Health tech, supply and demand in health tech is moving in ways that you just see inefficiencies in the market. And I think that there's an incredible opportunity to really rethink those dynamics at a global scale.
Great.
I'm going to be a little bit contrarian here. I do believe that today the opportunity to do stuff in blockchain is huge. The market might be down, but this is precisely the opportunity to build. So if you can now start a company, you're going to be able to find some people, good talent, good developers, and you will have enough time to build stuff. So when the market rebounds, there's going to be a lot of opportunity and a lot of capital.
Yeah. Nice. I was about to say a similar thing, but if I were to pick a different one, I'm going to be...
Sorry about that.
No, it's okay. We'll share that passion for blockchain. But I think I'm very passionate about future of work in general. I think we're at a point where many things in the way companies operate are changing, and solutions that are making other companies more efficient, increasing the engagement of their teams are in an area that I'm particularly fascinated about.
Super. Guys, thanks so much. This has been a privilege for everybody and super helpful for everyone. So thanks a lot, guys.
Thank you.